Assalamu alaikum. Hello, can you hear me? Right. Assalamu alaikum. Can you guys hear me?
Yes. Yes, can hear.
All right, let's begin. Inshallah, if anybody else wants to join, they can join, and the recording also will be available. All right. Before we start on today's topic that we'll be covering, inshallah, is PPE, which is property, plant, and equipment. We'll be talking about how we cost PPE, how we account for depreciation, and how we generalize them, and finally how we add them to the statement of financial position and any other any other financial statements that it has to go on. We'll go over that inshallah today. All right. But before we begin, regarding last class, which we dealt with adjustments, do you guys have any questions, anything that you'd like to be clarified before we begin today's class on PPE? Samira, you completed that question, the one that you had done?
Yeah, I think I completed it.
All right. Okay. All right, then let's begin today's class, inshallah. I'll share. Let me share my screen. You guys have your midterm holiday, mid-break holiday now, right?
Yeah.
Can you see my screen?
Yeah.
All right. So basically what we will do with today's class is similar to what we did with previous classes. I will just give a brief explanation on what PPE is. Your lecturer would have already covered it. So I'll just give a very quick rundown and then we'll do a question or two and you guys can clarify any doubts that you may have. Right. So like I mentioned in terms of PPE, the important parts are the first aspect of PPE is measuring the cost. So there's a way how we do this, right? Secondly, we have to account for depreciation. There are different methods of depreciation. And number three is generalizing these entries. What do we debit? What do we credit? And lastly, there's something called revaluation. The revaluation model versus the cost model. There are two types. These are two ways of valuing PPE, and we will go over them briefly, inshallah. All right. So firstly, what are PPE? PPE are long-lived tangible assets used for business. They are generally recorded at historical cost, which is the cost paid for the PPE, and the cost that is written down is not only the purchase price, but there are also other costs. Like installation costs, delivery costs, any cost that is required to get the asset ready for usage is classified under the total cost of the PPE that you are recording, right? And then under PPE we have land. So the reason I want to speak about land is when it comes to land does not depreciate. So when it comes to the costing of land, you add the purchase price, the whatever taxes that are there, any commission fees, all of that is included. However, when it comes to land, any improvements that you do to the land, for example, you build a fence or you build a wall or you put lighting, whatever, that does not come under the land cost. That will be as a separate a separate asset that will depreciate. Land itself does not depreciate, but other things like lighting, fencing, building walls, those things can depreciate, right? All right. And then next we have lump sum purchase. So this is, let's say you buy you buy multiple assets together, multiple PPE together at the same time. So you have bought a piece of land and a building for 150,000 ringgit, right? But now you need to put a certain amount for the building, a certain amount for the land. So the way you do this is, I'll do a small demonstration here. So let's say, let's say the land, let's say the fair value of the market price of the land is 120,000, all right? And then the market price of the building is 80,000. But you have bought the whole thing for 150,000. Now you need to apportion the cost. Now you need to put a cost for the building and a cost for the land, right? So what you do is you see the percentage of the market value. So the percentage of the market value is 100, like the total here, out of the total here is 200,000, the total market value. So 120,000 is 120,000 is
60%.
60% of 200 of 200,000. So 60% here and 40% here. So when you're apportioning the cost, now you have paid 150,000, right? So when you're apportioning the cost, you put 60% of the 150,000 for land and 40% of the 150,000 for the building. This is just a very quick way of doing it. And it's very straightforward. So if there's any question, the values will be given to you directly, you just have to apply it. Okay. And then next you have expenditures. So there are two types of expenditures: capital expenditures, revenue expenditures. Capital expenditures are any expense that you incur that increases your asset, the PP's capacity or its useful life, right? So this will add to the basically the value of the asset. Whereas when it comes to revenue, these are like repairs, certain things that you buy, maybe some the fuel or lighting, some small things that are expensive that does not add to the life of the asset. And so they are just expenses and they go into the SOPL basically. So the revenue expenditure is debited into the SOPL as expense, and capital expenditure debited as an asset into the SOFP, right? So that is okay. And then we move to depreciation. So there are really four methods of depreciation that are common. So the first one is straight line depreciation. I think you guys understand this. So this is the formula that is used. We will see how it is applied inshallah later on. And then you have the units of production depreciation. This is the formula. There are two steps here. You have to first you have to find the depreciation per unit, and then you have to find that, and then you can find the depreciation expense itself. Thirdly, we have the double declining balance method. This is the formula for it. And then lastly, we have just the declining balance method. And this is the formula for it. We'll cover them in the question, inshallah. It's hard to, these are formulas. It's not, so I mean, with regards to terms here, residual value is the amount that your asset will be valued at once its period of usage has ended. That is residual value. So there are many terms for it. Sometimes they call it scrap value. Sometimes they call it salvage value. These are different terms that are used for residual value. So we'll do a question, inshallah, and all of these will be covered in that. All right. Lastly, we have the disposal. So when it comes to disposal of an asset, there are three ways of disposing an asset. One thing is to discard the asset. That is just you throw it away without doing anything. Secondly, you sell the asset for a certain amount. And lastly, you exchange the asset for another asset. These are three ways of disposing the asset. And regardless of however you dispose it, the steps are more or not the same. So first you have depreciation. You have to check the depreciation. You have to bring it up to date. Secondly, you have to remove the asset and the depreciation from the SOFP. And thirdly, you have to, if you have gotten it for cash, if you have sold it and you got money for it, you have to record that. If you didn't receive any money, then there's no money to receive. If you have exchange it for another asset, then you have to calculate the value of that asset, and so on and so forth. And lastly, once you have recorded all that, you can determine whether you have made a gain or a loss on the disposal. And then if it's a gain, it's an income basically. You transfer it to the SOPL, and so likewise if it's a loss, right? So those are the steps for disposal. Once again, we'll probably cover this in a question, inshallah. All right. And then lastly, we have the cost model, the cost versus revaluation model. So there are two ways really of calculating or looking at PPEs. One is the cost model. So the cost model, what it does is it looks at the cost of the asset, the amount that the company bought an asset for, and it looks at the accumulated depreciation. Like that is how it works. The revaluation model is what does it? It takes into value the market price of the asset. So for example, you have a piece of land. Every 5 years or every 3 years, maybe the company will do a market value. What is the market value of the land? And then they will adjust the financial statements accordingly, because the revaluation model is mainly used for land and usually it's not used for anything else, because land is the one that can really change over time in terms of the market price, as opposed to normal depreciation. Land is what can maybe 1 year, maybe now a land may cost 1 million ringgit. After 10 years, it may cost 5 million ringgit. Like it could change. So the revaluation model takes that into account, the market value of the asset, and every few years the company will check the market value and they will make changes. So the revaluation model especially with regards to land, it produces relevant information for decision makers. So it's a useful way of calculating depreciation, not calculating on and checking the accounting for the PPE, right? So with regards to revaluation, so if now there are two possibilities. One is surplus revaluation, one is deficit revaluation. Surplus revaluation means that once, let's say you bought a land for 1 million, after 5 years, it has become 3 million. Like the value of it is 3 million. So this is a surplus revaluation. So in this sense, you will debit the asset PPE, the land itself on your asset sheet, that will be debited by 2 million because that is the increase, and you will credit revaluation reserve, which is under the equity, right? Which is under equity, and the opposite is done for when there's a deficit. So you debit the SOPL, right, and you credit the PPE. All right. So Was everything clear regarding, do you have any questions with regards to PPE before we move on to a question? Do either of you have any questions?
So far, okay.
All
Alhamdulillah.
right. Okay. Okay, so let's do a few questions for today, and then we can. All right. So these are the questions that I shared. All right. So let me create another one. Yeah. So what I'm going to do is I'm going to do question 1 and 2, and then I'm going to do question 5, because question 5 is a combination of everything. I think that'll make things a lot clearer, right? So for question 1, let's do this together, right? So question 1: Strike Bowling installs automatic scope keeping equipment with an invoice cost of 180,000 ringgit. The electrical work required for the installation cost is 8,000. Additional costs are 3,000 ringgit for delivery and 12,600 for goods and services tax, which is refundable. During the installation, a component of the equipment is carelessly left on a lane and hit by the automatic lane cleaning machine. The cost of repairing the component is 2,250. All right. So okay, now the question is very simple. What is the cost? So what is the cost of the automatic scorekeeping equipment? So Mira, could you okay, let's say, okay, cost of equipment, right? Okay. So first we have the purchase price, right? Purchase price is 180,000, right? So what should be from the remaining cost? Now that is the obvious one. The purchase price is obvious when you want to calculate a cost. But what else should be added from the remaining stuff? Could you guys say which one should be added as well to the total cost of the equipment?
Installation cost,
The
8,000.
electrical work. Okay, yeah, that should be added.
Delivery, 3,000.
8,000. Okay, delivery
3,000.
3,000. And then what else should be added? Should anything else be added?
That's it. No,
That's it, right? Okay, why don't we add the goods and services tax?
because this is a tax, not included.
Yeah, no, usually any let's say when you're buying a building, there is something called property taxes, right? Or you're buying a land, there's something called property taxes. These or any cost that is incurred up to that allows you to use the asset, that to make the asset usable, all of that is included in the cost. So just because it's a tax does not mean that it cannot be included. Actually, it can, but this specific one is not included because it is refundable. Because the company will get the refund from the government because it is GST registered, so it's not included in the cost. But typically speaking, if the tax is such that it is required for you to begin usage of the asset, then it should be included in the cost, right? It's not like it's not a repair or something extra. It is, if you don't do it, you can't use it, basically. And secondly, the other one, the cost of repairing 2,250. Why is that not added? Well, why is the second cost not added?
The repairing doesn't charge at that time when they install the machine.
Yeah. All right. Yeah, that's correct. Okay, that is one. Okay, then this is a very simple question. Let's just do two quickly, and then we'll do the question 5, which will take a bit of time. All right. So okay, this is question 1. So then the total cost of the automatic smoking equipment is 191,000. All right. Okay, then we have question 2. So okay, this is a bit more complicated. So question 2: a new machine costs 120,000 ringgit, which has an estimated useful life of 5 years, an estimated residual value of 15,000 at the end of that time. It is expected that the machine can produce 200,000 widgets during its useful life. The company purchased this machine on January 1st, 2019 and used it for exactly 3 years. During these years, the annual production of widgets have been 80,000, 50,000 and 30,000 units respectively. Okay. All right. So let's just, first of all, when you have a question, you write down the important information, right? So first, machine cost. Okay. Machine cost is 120,000. And then you have residual value, 50,000. Widgets, useful life, production. It was 210,000. Right. Okay. Okay. So now, first one is calculate the depreciation expense for each of the first 3 years. A is using a straight line method. B, units of production, and 3, diminishing balance. All right. So let's take 1. All right. 1 and then A. A is straight line. So we have to, regardless of the year, each year it's the same, right? So say you take year 1, all right, year 1 depreciation equals, what should it be? What would the depreciation be? What would the depreciation be for year 1? Let me copy this. No, okay. So what would the depreciation be for year 1? Do either of you know? So this is the formula. Depreciation equals cost minus residual value divided by useful life. So what's the cost?
120,000.
Okay, 120,000 minus residual value, which is 15,000,
Yes.
divided by, here the useful life is 3 years. It says here, the company purchased this machine for January 1st and use it for exactly 3 years. So divided by 3. All right, how much is that? Can one of you calculate? It's 105,000 divided by 3, right?
35,000.
35,000. Okay. So the depreciation expense is 35,000. And then this, it'll be the same for each year because the straight line depreciation does not change. So year 2 is 35,000. Year 3 is 35,000. You guys understood that? Is that clear? Straight line depreciation? Was that clear?
Why is it that every year is the same?
Yeah. So straight line depreciation, straight line depreciation, the depreciation expense remains the same each year. So basically, it just takes the total cost, the useful life, and it divides it equally among each year. Like every single year, the equipment depreciates by an equal amount until the end of the year. That is how straight line depreciation works. It's very straight. It's very easy. So this is the easiest type of depreciation, and to calculate. And so many people like it because it's very easy to do. So the formula is you take 120,000, you take the cost minus the residual value, and you divide it by the useful years, and each year it depreciated by the exact same amount. All right, that is the formula for the straight line depreciation. That is how it works. All right.
Useful life always given to in the equation, right?
Yeah, it has to be given. If the useful life is not given, you cannot calculate the straight line. So useful life is always given. So, but here, see over here, the bit of the somewhat tricky thing in this question is they didn't exactly say useful life is 3 years. They just said the company purchased this machine on January 1st, 2019 and uses it for exactly 3 years. So you have to be a bit alert as to realize what is the useful life, and then here it is 3 years, right? Okay, is that clear? How straight line was answered?
Yeah.
All right. Okay, next we have units of production. Okay, so units of production. Let me copy the. All right. Okay. So units of production has 2 steps. The first one is you have to calculate the depreciation per unit. All right. And then you have to calculate you can calculate the depreciation itself. All right. So the formula for, so now we have to first calculate what is the depreciation per unit of this machine. All right. So during this machine's entire life, it produces 210,000 widgets, right? Which is that is the product, right? So now it is now the depreciation is based on how many widgets is produced per year. So the depreciation per unit is depreciation per unit equals 120,000 minus 15,000 divided by 210,000, which is the number of widgets produced. This would be, how much would this be? Mm, 105,000. Yeah, this would be 0.05 ringgit. So this is the depreciation per unit. Now we can calculate the depreciation itself. So then we have year 1 depreciation. Okay. So year 1 depreciation equals, so then now it's just depreciation per unit into the current year, production. So you have 0.5 into the first year production is 80,000 into 80,000, which would equal 40,000. All right. And then you have, let's just copy this. And then you have year 2 depreciation. This is 0.5 into 50,000, which is 25,000. And then you have year 3 depreciation, which is 0.5 into 30,000, which is 15,000. So here, yeah, wait. Total depreciation expense equals, sorry. Okay, so then so this is the year 1 depreciation, this is the year 2 depreciation. And this is the year 3 depreciation. Oh wait, sorry, I made a mistake. You guys can correct me. So it is mentioned here, a new machine costs an estimated useful life of 5 years. Yeah, okay, I did not see that. My bad. All right. Actually, this is 5 years, right? So then if this is divided by 5, yeah, okay, my bad. If this is divided by 5, how much would this be?
What does the question mean by
What
calculate
do you mean?
depreciation expense for the first 3 years?
Yeah, so you had to calculate the depreciation expense for each year. You understand? So if the useful life was
Or the useful life is 5 years, but we have to count it for 3 years only.
yeah. So for each year you calculate, and then So the total depreciation for those 3 years is for those 3 years is 60 using straight line method. Using the units of production method, year 1 is 40,000, year 2 is 25,000, and year 3 is 50,000, because this is based on how many widgets are produced. So the total depreciation expense is 80,000 here. You understood this? You guys got it?
Yeah.
All right. And then, okay. I didn't see the, okay, that was my bad. All right, then we have the diminishing balance method. So this is the most, this is the trickiest one, okay? Right, and this is, okay, the rate is 40%. So the formula for this is, the formula for this is, for each year is basically cost minus residual value minus accumulated depreciation into depreciation rate, okay? So for this, okay. See, in year 1, all right, in year 1, depreciation equals cost is 120,000 minus residual value, which is 15,000, minus 0. There's no accumulated depreciation, right? As of yet, during the year 1. So there's no accumulated depreciation into 40%. Okay, so right. So this would be okay, how much is 105,000 into 40%? This would be 42. Yeah.
42,000.
Yeah, this would be 42,000. All right. So this is now okay. Right. There needs to be a separate column for accumulated depreciation. So accumulated depreciation is at the end of year 1 is 42,000. All right. And then you have year 1, year 2 would be 120,000 minus 15,000 minus 42,000 into 40%. How much would this be? Uh, 5,000 minus 42,000 into 40%. This would be 25,000.
25,200.
Yes, 25,200. And the accumulated depreciation would be the addition of the two, which would be 67,200, right? And then year 3, would be this one. The difference is 67,200. How much would this be? 7,200 into 40% should be 15,120 plus 82,320. Yeah. Is it clear? You understood how this was done?
How did you get the 42,000 and the 67,000?
Yeah. So accumulated depreciation is basically it adds up, right? So at the beginning, like at year 0, it is the accumulated depreciation is 0. Let me just make that just to make it clear. Year 0. Oh, come on. Year 0, accumulated depreciation is 0, right? And then at year 1, depreciation expense is 0 for year 0 at the beginning, right? So for year 1, the formula is cost minus residual value minus accumulated depreciation is into 40, so 42,000, right? So then after at the end of year one, accumulated depreciation is 42,000. Year two's depreciation expense is 25,200. So the accumulated depreciation is 42,000, which is already there, which already happened in year one, plus year two's depreciation, 67,200. Lastly, you have the year three depreciation expense. So for the year three accumulated depreciation, you add all the basically all these, and you get so each year it adds up with each expense. The accumulated depreciation adds up. Yeah, that's how I got it. Is that clear?
Yeah.
All right. Okay. So that is question 2. So this is very basic, but this is just to basically illustrate how it works, right? So let's do question. All right. We'll do question 5, because this is quite big and it's quite complex. I think this would be a good question to do, inshallah. All right. Okay. Okay. So question 5 we have is below is the trial balance extract of way forward Berhad as at 31st December 2016. All right. So this is the trial balance where PPE has been debited by 840,000. Accumulated depreciation is 240,000. Cost of sales 268. Administrative cost 154. Distribution cost 110. All right, and then we have this additional information here, which is the value of the land, the building, the machinery, and so if you sum this up, 300,000, 240,000, 210,000, and 90,000, you get 840,000. All right, and the accumulated depreciation is also for the building. It's here, and then they tell us here what is the depreciation method for the building. So the building has used a straight line method, 2% per annum. The machinery has used units of production method, and the motor vehicle has used a diminishing balance method, 25% per annum, right? So we covered each of these methods in the question 2, so you guys should know how to do that as well, right? And once again, if you total up the accumulated depreciation, 70,000 plus 150 plus 20, you will get 240. That's just to see if it balances off, right? So that is the first point. The second point is depreciation is to be provided based on month of ownership basis. During the year ended 2016, the company's production is 7,200 units. Point 3 is October 1st, 2016, the company purchased a new motor vehicle at the cost of 160,000. This is not been recorded, and on December 31st, the land was revalued to 380,000. This transaction has not been recorded, right? So now, so that's the information that is given in the question. Now we must cover what is required, right? So first of all, which is part A, which is part A, calculate the depreciation of the building, machinery, and the motor vehicle for the year 2016. Okay. So let's take part A, right? Okay, let's first cover the building, right? So the building is depreciated. The cost of the building, or the value of the building, value is 240,000, right? And the accumulated depreciation is
70,000.
70,000, right? Now for straight line, now it is depreciated at 2% per annum. So what would the depreciation be for 2016 for the building? See, straight line. Okay. Now with regards to straight line, there are two ways which it can be given the question. One thing is the estimated useful life, right? Which is, if they give you the estimated, if it's estimated useful life, then you have to divide the cost with the useful life, and then then you get the depreciation expense, and you divide, and then each year it's the same amount, or they will give you a percentage. If they give you a percentage, it's that percentage every year. So now the value, yeah. So here the depreciation expense would be 240,000 into 2%. this would be 4,800. So this is the depreciation expense for the building for the year 2016, right? Only for the year 2016. This would be the depreciation expense on the building, right? So each year it is depreciated by 4,800 ringgit, right? And then we have okay, then we should do machinery, right? Okay, machinery. All right, machinery is it's a units of production method, right? So for units of production method, what is it we need to have the depreciation per unit, right? Wait, let's look at the value first. The value is 210,000. All right, and the accumulated depreciation is 150,000. 150. Okay, so now we have to get the depreciation per unit, and then only we can get the depreciation expense for the year 2016. So the depreciation per unit, what is it? What should it be? How do we get the depreciation per unit? We went over this in the last question.
Where we
What is
can
the
find the useful life years.
I'm sorry, what?
Where we can find useful life.
Useful, what useful? For depreciation per unit, you don't need the useful life. For depreciation per unit, you need the total units of production. Because see, depreciation per unit, now the straight line unit uses the useful life, or it uses the amount of time that you will be using the machine, right? Depreciation per unit, it uses the amount of products that will be manufactured by that machine, right? So let's say over a period of, the period does not, the period does not necessarily matter, but let's say for the whole life, you're buying this machine for 100,000 ringgit, right? And you're going to produce 50,000 units over the next 5 years. So for each, for each unit that is produced, right? For each unit that is produced, 2 ringgit is depreciated. Basically, it's 100,000 divided by 50,000. So that is a depreciation per unit. So if you once you have produced 25,000 units, which is 50% of the total production, the depreciation of the asset itself also is by 50%. So that is the idea behind it. But the formula is simple. You have cost divided by total units of production. So here, the cost or the value is 210,000 divided by 60,000, which is the total units of production. And this equals, how much is this? 210,000 divided by 60,000. This is 3.5 ringgit per unit. So for every unit produced, 3.5 ringgit is depreciated from the machinery. Okay, that is the explanation. That is explanation for depreciation per unit. And then now we have the depreciation expense. Okay, now this is easy. What is the depreciation expense for the year 2016? Yeah, what is the depreciation expense for the year 2016? What is the formula? Do you guys remember the formula? How do you find the depreciation expense when you're using the production unit method? Hello, are you guys there?
Yeah, I'm not sure.
Okay, see the formula is depreciation per unit into current year usage, right? So, okay, what is the depreciation per unit?
3.5.
3.5. And what's the current year usage?
7,200. Is it correct?
Yeah, 7,200. So that's it. Now, what would the depreciation expense be?
25,200.
5,200. That's it. So that is the depreciation expense for the machinery for 2016. It's very straightforward. And then next you have motor vehicle. Okay, this is a little more complicated, you could
Sir,
say.
I have a bit confused when we
Yeah,
calculate the depreciation per unit because there is no useful life, right? Like we do the question one.
yeah, yeah.
Question two.
How
See,
did
no,
you get 7,200?
yeah. See, for question two, the question two, for units of production, to find the units of production, we did not need to know the useful life. So here in our working here, we did not use the useful life.
Oh,
This one, what we need to know is we need to know the cost. We need to know the value or the cost of the asset. We need to know how many units it'll produce. So once we get that, once we know the cost and we know the total number of units produced over its full life, you can get the depreciation per unit. And then once you get the depreciation per unit, to find the depreciation expense for a specific year, you just multiply that by the number of units that they're making in that year. And then you get the full depreciation expense. So you don't need to have the useful life for the units of production method. You get it?
uh, sorry. Yes, I get it. I confused with the machine, the number the machine can produce. Okay.
Yeah. Yeah. So for the for the units of production method, you don't need to know the useful life. You just need to know the total units of production, and you need to know, of course, the current year usage, like the year that you want to calculate the expense for. You need to know how many units were produced, and that way you can depreciate it, right? Okay, that's clear, right? Is that clear?
Yes.
Yeah.
Okay, okay. All right, then we have the motor vehicle, right? So so now actually there are two motor vehicles. So there is a motor vehicle that was already here, right? That was in the that the value of it is 90,000, right? Okay. So there are two vehicles here. The first one is the vehicle that the company had at the beginning of the year, right? Which is here, and uh, they bought a new vehicle as well on October 1st, 2016. So for this vehicle, we will have to for this vehicle we will have to depreciate it using we'll have to depreciate using for the whole year. But for the second vehicle that was bought in October, we'll have to depreciate only for 3 months: October, November, and December, right? So for for vehicle one, okay. So the formula of the method used is diminishing balance method, right? Let me just copy the formula so it's easy. All right. Yeah. Okay. So here the formula is cost minus residual value minus accumulated depreciation. Yeah. You said you were saying something.
Yeah, and multiply by the
Yeah.
percentage.
Yeah. Multiply by the percentage, right? So the depreciation expense would be okay 90,000 minus. So they have not mentioned a residual value. If they have not mentioned a residual value, you assume that it does not exist, right? Uh, they have not mentioned. Yeah, they have not mentioned it. So we don't have to mention. You don't have to write -0, of course. And then accumulated depreciation is 20,000 into 25%. So this would be, how much would this be?
17,500.
17,500. So this is the depreciation expense for vehicle one. All right. So for vehicle two, okay, vehicle two was bought in October, right? That is important. We have to remember that, right? So vehicle two was bought in October, and it was a new vehicle, so there is no accumulated. So let's say depreciation, there is no accumulated depreciation because it's a new vehicle. So here depreciation expense equals what is the cost? 160,000, right? Once again, they have not mentioned the residual value, nor have they mentioned accumulated depreciation. So we just multiply this by 25%, okay, and we also multiplied by 3/12 because we have to record it only for
3 months.
the year that we had it, right? So how much would this be? 160,000 into 25% into 3/12. So it would be 10,000, correct? Is it 10,000? You guys have you calculated it?
10,000.
All right. And so the total, let's call it MV depreciation equals sum this amount yeah. So this is the total motor vehicle depreciation for the year 2016. So vehicle 1 is 17,500. Vehicle 2 is 10,000. Was that clear? How we did that?
Yes.
For vehicle 2, we just multiply by 25,000 because there is no accumulated depreciation,
Yeah.
right?
Yes, there's no accumulated depreciation. So I mean, to make it easy, if you really want, you could do something like this. You can put -0, -0, but you know, it would be the same thing. You understand? So I just did not write the -0. I just directly multiplied it by 25%. That's clear, right?
Yes, sir.
Okay. All right. So okay. So basically, we have done part A, right? So part A is done. Part B is now generalizing the above transactions, right? So in the first one, wait, why don't we do, if you do part B here, it's easier next to it. All right. Okay. So okay. All right. So here for the first one, we have depreciation expense of 4,800. This is very easy. We did this last 2 classes. So what should be debited? What should be credited here? What should be debited and what should be credited?
Debit PPE. Is it correct?
No. There's an expense here. Debit expense. Debit depreciation expense. Right. So there's an expense. It has to be debited. Debit depreciation expense 4,800 and credit what? This is the basic entry for any depreciation. You debit depreciation expense and you credit what?
Accumulated.
Yes.
No.
Yes, accumulated depreciation. 4,800. Okay. And then over here, here same thing, yani. So we have depreciation expense 22,500 and we credit accumulated depreciation 22,500, right? And yeah, and over here we keep it separate. It's easy to keep it separate for each of them. So we have debit depreciation expense 17,500 and credit likewise over here 10,000. No? Sorry. Exactly. Yeah, so we debit we debit depreciation expense 10,000 and we credit accumulated depreciation 10,000. This is, you guys got this right. I mean, this is very straightforward. We did this before as well.
On
Was
the
this clear?
machinery,
The journal did
25,000.
where?
Why is it 22,000?
Oh yeah, sorry, that's my mistake. Okay, 25,200. Okay. All right. So that's clear, right?
Yeah.
Okay. Depreciation expense. All right. Okay. And then lastly, show the extract of the statement of profit or loss and other comprehensive income for the year ended 31st December and statement of financial position as at that date. Okay. All right. So
Sir,
yes.
for the motor vehicle, we done adding up for the vehicle 1 and 2 in the journal entry, right? We just do separate.
Yes. Yes. You could do it together. Like, I mean, see, no, it would be better to do it separately. True. Yes. We in the journal entry, you just keep it separate, and even in the financial statement, you can just keep motor vehicle 1, motor vehicle 2. It makes it much clearer that way. If you combine them, sometimes you might make an error. Is that clear?
Yes.
All right.
Yeah.
Okay. So financial statements. So now, okay. So now we show the extract of the statement of profit or loss and other comprehensive income. So the only thing that'll be shown in the SOPL are the expenses, right? So the depreciation expense. So when for each depreciation, so let's just do it, right? So where is that? I had okay. All right. So what are the things that needs to go into the SOPL here from the journals that we have done? What needs to go into the depreciation not into the SOPL? It's all the depreciation expenses, right? So we have, oh sorry, we didn't do this, right? We didn't cover.
Yeah.
No, we haven't.
Oh, yeah, we haven't. Okay, let's do that. All right. So that'll be basically for B. That is only there for B, really. Okay. Revaluation, right? So the freehold land was revalued at 380,000, right? So this is a revaluation surplus because the cost of it, I mean, the value of it is 300,000, and that has now increased to 380,000. So as I showed here in this one, when there's a revaluation surplus, you debit the PPE, the freehold land, and you credit revaluation reserve. So here you debit freehold land by 80,000, but that is the difference, right? And you credit revaluation reserve by
80,000.
80,000. All right. Yeah. Okay. So that is covered, right? Okay. So here, so the first similar problem we have. So it'll come under expenses, right? Expenses. Okay. And then we have depreciation expense.
Okay.
Expense for building. All right. How much is the depreciation expense for building? It's 4,800, right? So 4,000.
4,800.
Yeah, 4,800. And then we have depreciation expense for machinery. How much is this one? 25,200, correct? 25,200. Okay, 25,200. Then we have depreciation expense, MV1. This is 17,500. And then you have depreciation expense, MV2. This is 10,000. Okay, so yeah. Then yeah, so this is the so this is the extract of the statement of profit and loss. And I mean, they have not given us, this is not a full question where they have included we could have cost. Okay, wait, let me just add this. See, they have given us cost of sales on top. Cost of sales, which is 268,000, but we don't know what the gross profit is, because we don't have the revenue. They haven't given us the revenue, right? And then we have, admin. You can let's add admin costs. Admin costs is 154,000. And then you have distribution costs, which is 110,000. 334. Yeah. So
So basically, we're supposed to put the admin costs and distribution costs or not?
yeah, and they have given us the admission. This is now we are creating the statement of profit or loss, right? So ideally, they would give you revenue. For example, let's say they give you revenue is equal to 1 million. All right. So then the net the gross profit would be this one minus one second. Sorry. So ideally, this would be the case. So there will be you'd have the gross profit, which is the sum of these two, and then you'd get the net profit here. I mean, you'd get the operating profit here, which is minus these expenses, right? And then you would have the taxes and all that stuff. So, but then the part that they want to, but they have not given us revenue, they have not given us out, they've just given us these expenses, right? So yeah, we can't really put any of this stuff here. We can just put we can only put what we've been given, right? But the part that they want to see is how would these depreciation be, where would it be listed? So if you put it like this, if you give them this answer, it fulfills what is required from you. So you have shown where the cost of sales would come. You've shown you've shown what the expenses, where the expenses would come. You bet. I mean, admin cost, distribution cost, all of that would come under expenses, right? And then you add the depreciation expenses below them as well. Yeah, is that clear?
Yeah.
Okay. All right. Now we have statement of financial position, right? Where's that? Statement of
Sir, how about the evaluation for freehold land, where we record it?
yeah. See, yeah, we actually need to record that. See, but they have not asked for the statement of but let's just do that to make it easier. All right, wait. To the revaluation surplus. So typically speaking, like we had done that day, first you do the SOPL, then you do the statement of changes in equity. Contained within that is revaluation reserve, and then you do the statement of financial position. But here they have not asked us to do the statement of changes in equity, but let's just do it regardless. So it'll only have one. It'll only have one this one. So it'll have freehold land, freehold revaluation, and this would come to 80,000, and then totals equals, yeah, like this would be the only thing. There's nothing else, because we don't have information about the share capital. We don't have information about the retained earnings. None of that we have, right? In a full question, of course, you would have share capital, you would have revaluation reserve, and they'd all be, and you would have maybe dividends. All of that stuff would be there, but here you don't have that. So yeah, if you want to show it in the changes of equity, this is what you would show, and then this would basically be moved into the statement of financial position like we did last time. So in any case, let's do it. So we have assets, right?
Mm.
So what are the assets we have? We have the land, okay. We have, okay, we have the freehold land. So what would be the value of the freehold land here?
300,000.
No, not 300,000.
Mm.
It would not be 300,000. How much would it be? It was
So
revalued,
minus
right?
for the
Is it 380,000?
Yeah, it was revalued. So once it's revalued, that is the value that'll be put, that'll be added to the assets, right? And then we have the building, okay. So under building we have, wait, let's put it like this. Yeah. Building, we have value, and we have accumulated depreciation. So the value is to 40,000. All right. And the accumulated depreciation is 70,000 plus this amount, plus 4,800. So that will be 74,800 for the current year. So, I should be 74,800. So then the value of the building
$165,200.
yeah, it'll be this is the value of the building, right? Okay, and then likewise, let me just copy this, change the name. Then we have machinery. What is the value?
210,000. 210,000.
210,000, right? And then we have accumulated, we have 150,000, and the depreciation that is here that happened this year is 25,200. So that'll be 175,200. 175,200 equals sum this value, right? So that is the machinery. And then we have, where is it?
200, yeah.
Then we have, okay, then we have motor vehicle 1. Then we have value, which is 90,000. Then we have accumulated depreciation, which is 20,000 plus 17,500. 70,000, yeah, 70,500. So that is 37,500 equals sum. Oh wait, sorry. It should be minus. Yeah. Yeah, all right. That should be minus. And then we have motor vehicle 2. The value is, how much is the value of the motor vehicle 2? What's the value of the motor vehicle 2?
160,000.
160,000. And then the accumulated depreciation is 10,000. There was it. It is nothing to begin with. It'll be 10,000. Okay. So yeah.
How did you get the 74,800?
Which one? Oh, this one here. Okay.
Yeah.
Yeah. So the accumulated depreciation. So the beginning of the year, 16. So we have this, and then the depreciation expense for 2016 is 4,800. So you just plus it, whatever accumulated depreciation coming into the year, plus the depreciation expense for 2016 as well, 74,800. That's the same thing that we did for each one. So for machinery, it was 150,000, and then the depreciation expense this year was 25,200. So we added them together. Together, the accumulated depreciation became 175,200. Likewise with each asset. Yeah, is that clear?
Yeah.
Okay. All right. Okay. So those are the assets. Of course, we cannot do a full financial position because we don't have the account payable. All this, a lot of stuff we don't have. But these are the changes required in the financial position, right? All right. And then we have liabilities and equity, right? Once again, they have not. We don't know anything about the liabilities, right? right? So we don't like, they haven't given us that information. But under equity, you would have revaluation reserve. Revaluation reserve, which would be 80,000. See, the point is this: any increase that is there, if there's an increase in one side of the of the equation, the other side also. So here, freehold land increased by 80,000. So at the other side, the liabilities and equities increased by 80,000. All of these increases, but to the accumulated depreciation, they are shown in the statement of financial of profit or loss. So for every single transaction, like, I mean, the double entry rule is very simple. Every single transaction has to be shown in two areas at least, so to balance it out. So yeah, so this is where the revaluation reserve will be shown in terms of the financial position, in terms of the statement of financial position. And of course, if you have a whole question where all the data is there, you can have a complete financial position where, you know, the liabilities and equity equals the assets, but that's not really that's not needed for this question. So yeah, so this is how it should be shown. All right, is that all clear?
Yeah.
Okay, all right. Uh, okay, this was question 5, right? Okay. All right, so I think that is clear. So are you guys clear on everything with regards to this question?
Yes.
All right. Okay, so if you guys could do question 6, like at least attempt to do question 6, because question 6 is it's actually also easy. It's not very difficult. Easy in the sense it's like this question. Sometimes accounting can be a bit tedious, especially financial accounting. It can be a bit tedious, and you just have to make sure you don't make any silly mistake. So if you guys could do question 6 and like try it out on your own and see if you can follow the steps that I have done for this question. You guys will, I'll upload the recording as well. And you can try to do question 6. If you're able to do question 6 fully, as in they have asked over here to calculate depreciation expense, to journalize all transactions, which we did in the question 5 as well. And then they asked to show how the company's property, plant, and equipment is present in the same financial position. Once again, something we did for question 5 as well. And lastly, explain. All right, this is a bit. Yeah, these I don't know. I'm not. I had to look into that a bit further. I'm not sure exactly what should be. That's like a minor. That's like a 1 mark question anyway. But the main thing is ABC, right? So if you guys could try question 6 in during the week, just to ensure that you have full understanding of what we have covered today, that would be great, and it would be better for you guys as well. All right. Okay. So you guys have any other questions before we end the class?
For example, you told us to try and do question 6, right? Will you
Yes.
upload like the sample answers, or we have to ask you whether it's correct or not?
If you could do it and send it to me, that'd be better, because and then I can correct you. Like
Okay.
you can just contact me directly, or something of the sort, and you just do it the way you can. Whether you, if you want to write it, it's okay. If you want, like you said, you were telling me that your exams are all paper based. You cannot do it on Excel, right? So if you want to write it, it's okay. Or if you want to do it on Excel, either way, it's fine. But just try it and try to get the correct answer. And if you get meet any difficulty, just let me know, inshallah, and I'll help you out. All right.
Okay. Can you please scroll up a bit?
Yeah.
Okay. Hold on. Can you please stop there? Okay. So basically, we have to write the cost of sales and the answer will be a negative 3,221, is it?
What?
We have to write the cost of sales as well, right? And then we'll get the answer is the negative 321. We have to write it like that.
No, this is the sum of this. 3221 is the sum of the expenses only.
All of those have to be minus, right?
Yeah.
Okay.
All of these need to be minus. These are expenses. So see, like I was saying, in a normal similar profit, there'd be revenue, right? And then you would get the gross profit, which is revenue minus cost of sales or cost of goods, either way. Then you minus this gross profit minus the expenses, which would be all of this, which would be gross profit minus 321,000. And then you get operating profit. And then from operating profit, you minus out the interest expenses, tax, and those, you for let's see, let's open where's the in the second class, like we covered it, right? So the normal, yeah, it was this one. I see. Yeah, we have sales revenue, and then you have cost of sales here. It's either cost of sales or cost of goods. It can vary. Then you have gross profit. So basically what we needed to show for this question was really only this part, the expenses part. And like, because they give us the cost of, I just added it over there. And so then you get profit before tax. Yeah. So they haven't given us all the information to make a full. That's why they said in the requirements, they say over here, show the extract of the similar profit or loss. So they just want to see how it will be shown in the under the expenses part of the SOPL. They wanted you to show how it will be shown. So if you show it like this, I think, I'm not certain, but I think even if you don't show this, it will be fine. But I just added it because they have given it over here. But I think that even if you don't do this, it should be fine, because this is the part that they really want to see. To see, they want you to show what is the total expenses for the year. So you add the admin costs,
Okay.
distribution costs, and all of it. Yeah.
Because it's an extract, so they don't give us the full information. We only have to show the expenses.
Yeah. See,
Okay.
typically in an exam, in an exam question, they will give you all the data, and then they will not only ask you about PPE, right? They might ask you other stuff. This would be included. So for the tutorial, because we don't really want to do so we want to mainly focus on the PPE part, we're just doing this. You get it. But in a main question, in the final exam question, the other stuff also be there. So then if the other stuff are there, it'll be easy. You do the same thing that you did here, plus you just plug in the remaining values that they would give you, to complete the SOPL. Yeah.
Okay.
Yeah. Is that clear, right?
Yeah. Thank you.
Okay. All right, then I think if you guys don't have any other questions, inshallah, I think we can end the class. Jazakallah khairan for attending. I'll upload the recording as well. سبحانك اللهم وبحمدك أشهد أن لا إله إلا أنت أستغفرك وأتوب إليك. السلام عليكم ورحمة الله وبركاته.
Salam. Thank you.